Welcome to The Explainer. Today we are digging into a massive decision from the Federal Reserve, America's central bank. So, they all got together, had their big meeting, and then decided to do, well, nothing at all. But, believe it or not, sometimes doing nothing is the most fascinating move they can make.
Okay, so let's get right into the mystery here. On the surface, it sounds like a non-event, right? But this big pause is actually packed with clues about the health of the entire U.S. economy. Think of it like a detective story. We're going to follow the exact same clues the Fed is looking at to figure out why on earth they're holding steady.
All right, clue number one. And this is a huge piece of evidence, pointing in a really good direction. I'm talking about the U.S. job market. It has been shockingly strong. And for the Fed, this is a major part of the puzzle.
Okay, check this out. 150,000. For the last 3 months, that's the average number of new jobs created each month. Now, that's not a crazy booming number, but it's really solid, it's consistent, and it tells the Fed that businesses are still hiring, they're still feeling confident. That's a huge green flag.
And what does all that hiring get you? It gets you this, an unemployment rate of just 4.1%. You know, historically speaking, that is incredibly low. And what's more, it's been super stable for about a year now. So from the Fed's point of view, one half of their job, what they call maximum employment, is looking pretty darn good.
And you don't have to take my word for it. The Fed themselves said it. In their official statement, they wrote that the job market is, quote, broadly in balance and consistent with maximum employment. That's Fed speak for, yep, mission accomplished on the jobs front. So, if the job market is great, what's the holdup? Well, that leads us right to our next clue, and this is where things get a little more complicated.
Okay, on to our second clue. And this, my friends, is where the plot thickens. Because even though the job market is humming along, the overall economy, well, it's starting to pump the brakes. So just look at this comparison. Last year, the economy was growing at a pretty healthy 2.5% clip. But if you look at the first half of this year, that speed has dropped to just 1.2%. Now that is a really noticeable slowdown. The economy's not crashing, not by a long shot, but it has definitely eased its foot off the accelerator.
So what's going on here? Well, it mostly comes down to us, the consumers. We're just not spending quite as freely as we were. And even though businesses have actually started investing a bit more, it's just not enough to make up the difference. So you've got this real head-scratcher for the Fed, a hot job market, but cooling economic growth. That's a tough one. But it's not even their biggest headache.
Which brings us to our third and final clue, and honestly, this is the big one. This is the smoking gun. It's the #1 reason the Fed is being so cautious right now, and that is the stubborn, persistent problem of inflation. See, the Fed has a very specific public target for inflation, 2%. That's the magic number, but we're just not there. Their favorite way to measure it, which is called core PCE inflation, is sitting at 2.7%. And yeah, that's way down from where it was, but it has stopped falling. It's just stuck.
And you might be hearing this term, core PCE, and wondering, what on earth is that? Well, it's actually pretty simple. It's just a way of measuring price changes that ignores the things that bounce around all the time, you know, like the price of gas or groceries. Stripping those out gives the Fed what they think is a cleaner look at the real underlying trend of inflation. Now, if you peek under the hood of that 2.7% number, you see this weird tug of war happening. The price of services, think of things like getting a haircut or your car insurance, those prices are actually coming down. That's great. But at the exact same time, new tariffs on some goods are pushing other prices up, basically wiping out some of that progress. It's like taking one step forward and one step back.
So let's recap the evidence. We've got a strong job market, check. We've got slowing economic growth, check. And we've got this sticky, stubborn inflation, check. When you lay it all out like that, the Fed's decision to just pause starts to make a whole lot of sense. And don't mistake this for them just taking a nap. This is a very active strategy. They are in full-on wait-and-see mode. And it's a three-step dance. First, they're poring over every new piece of data. Second, they're constantly updating their forecast for what might happen next. And third, they're weighing the risks. It's about being patient and deliberate, not lazy.
And again, the Fed told us this directly. They said they are, quote, well-positioned to learn more about the likely course of the economy before they do anything else. In plain English, They're hitting pause to gather more intelligence before they make their next move.
And they've got a lot to watch. They're keeping a close eye on how government policies might shake things up. They're trying to figure out if this inflation from tariffs is just a quick blip or something that's going to stick around. And underneath it all, they're walking this tightrope. Do they act tough on inflation and risk hurting that awesome job market, or do they protect jobs and risk letting inflation stay too high for too long?
So, why does any of this matter to you? Why should we care about this incredibly complicated balancing act? Well, it all comes down to the Fed's most basic, fundamental reason for existing. It all boils down to something called the dual mandate. Congress has given the Fed two main jobs, two core goals. Goal number one, keep as many Americans employed as possible. Goal number two, keep prices stable, which, as we know, they define as that 2% inflation target. Literally every single thing they do is meant to serve one of those two goals.
So here it is, the final scorecard. Based on all the clues we just walked through. Maximum employment? Check. With unemployment this low, they've pretty much nailed that one. But stable prices? Nope, not yet. Inflation is still running too hot. And this right here is the central conflict, the main dilemma the Fed is dealing with right now.
And that leaves all of us with the big million-dollar question for the future. With one goal in the bag, but the other one still just out of reach, which side of its mission will the Fed lean into next? Will they choose to fight that last bit of inflation, even if it puts the job market at risk? The answer to that question is going to shape the economy for every single one of us. Thanks for watching The Explainer.